Yeah, ladies and gentlemen, welcome to the second part of this presentation. As you see, we go on with impact measurement. I go to the next slide. Impact investors want to ensure that they achieve desired impact results regarding the world's social and environmental challenges. Thus, effectively measuring and managing impact is very important for them. The current situation on impact measurement and management, called IMM, can be characterized like that. Impact investors try to create many different types of impact. IMM is for impact investors a basic prerequisite and part of the core activities. Individual approaches cause the problem that impact reports are not very comparable and transparency suffers as a result. A handful of procedures have emerged over the years that are predominantly used. The impact industry made significant progress, but yet challenges in impact measurement and management persist. On this slide, we present you the results of a survey on the use of impact measurement and management tools. As you see, the UN, United Nations, SDGs are with 73% very popular. There is a big gap between the first and the following four tools. It's important to note that after listing 10 tools, others still show 17%. And finally, there were still 11% of responding impact investors saying that they do not use any external tool or framework. Probably they use internally developed individual tools. Now we discuss on the following slides the 5 most important tools. These are the UN Sustainable Development Goals, IRIS Catalog of Metrics, IRIS Plus Core Metrics Sets, then the Impact Management Project, IMP, and finally the UN Principles of Responsible Investment, UNPRI. So we start with an overview on the United Nations Sustainable Development Goals. On this slide you have a list of all 17 goals. Probably you have seen them already in other classes. I don't want to go through that, but you see we start with no poverty, with zero hunger, and we finish with goal 17, partnerships for the goals. It makes sense to look at them on your own and trying to understand what's going on in these Sustainable Development Goals. The following slide shows how SDGs are targeted by investors. This is from 2019, a survey from 2019. Interesting to see that the numbering of SDGs does not match with the impact priorities of investors. Investors' priorities are not 1 and starting with zero hunger and no poverty and so on. No, they start with 8. 8 and then 1, 3, 10, 7, 5, 11 and so on and so on. You see, the UN numbered the SDGs according to their perception of importance. And now we have to accept that investors base their impact investments probably on a different goal set. which is quite interesting. On this slide, we have the opportunity to look into a specific company and to learn how this company, and the company is PwC in Netherlands, how this company did their impact decisions. The example here for SDG impact measurement in 6 steps is as following. There is step 1, determining most material and focus SDGs. Step 2, defining indicators. Per each material SDG, selecting indicators is the basis for SDG impact measurement. Step 3, defining ambitions and targets to minimize negative impact and maximize positive impact. So targets are specific aspects of ambitions. Step 4, collecting data and calculating impact scores with the help of Responsible Business Simulator, developed by PwC, which enables strategic decision making based on financial and non-financial information. Step 5, visualizing and interpreting the results, repeating it year by year, for example. Progress can be assessed, and so on. And last step, number 6, exploring opportunities for improvement. Now we will leave the SDGs, but you will have the opportunity to discover more background knowledge on this important topic in one of the following chapters. So we come to the next tool, and this is IRIS Catalog of Metrics. The GIIN promotes impact measurement as an essential part of impact investing and offers IRIS as a free public good to support transparency, credibility, accountability in impact measurement practices across the impact investment market. IRIS metrics are designed to measure the social, environmental, and financial performance of an investment. To use IRIS metrics and the resulting data as part of the investment management process, IRIS metrics should be used and analyzed in generally accepted sets and according to well-defined objectives. And the last hint, IRIS metrics is a tool developed by GIIN, and this is also the case for the now following tool. And this following tool is called IRIS Plus Core Metrics Sets. Credible, comparable impact data are needed to inform impact investment decisions. Effective measurement and management of impact data is essential if investors are to know whether they are actually achieving the impact they seek. IRIS Plus core metrics sets are short lists of key impact performance indicators built on standard IRIS metrics and backed by evidence and best practice that impact investors can use to assess the effects of their investments. The IRIS Plus core metrics sets document describes its main elements of the IRIS Plus core metric sets, which means the questions they address, short list of key indicators, clear step-by-step calculation instructions, and the key insights derived from each indicator. Now we discuss Impact Management Project, IMP. IMP provides a forum for organizations to build consensus on how to measure, assess, and report impacts on environmental and social issues. IMP is hosted by Bridges Insights, a UK-based non-for-profit institution that works to build the market for sustainable and impact-driven investing. This company, Bridges Insights, also publishes a lot of material, so if you check the internet you will find many documents by Bridges Insights on impact investing. IMP works with 5 dimensions of impact: who, what, how much, contribution, and risk. Enterprises, investors, and fund managers are beginning to apply the dimensions to better understand their impacts, as well as portfolio and individual investment performance. One way of measuring the impact of a project is to pilot test it on an area of business and compare it to a control group, which could be a comparable area for the business or the previous state. The last tool which we discuss here is the United Nations PRI, Principles of Responsible Investments. PRI investors should align their responsible investment practices with sustainable objectives, SDGs being an excellent objective. With a combined $89 trillion in assets under management, PRI signatories can play a unique role in helping the world to meet the SDGs individually and in collaboration with fellow investors and broader stakeholders. A focus on shaping outcomes involves broadening the analysis of individual investees' financial material ESG issues to also include a parallel analysis of the most important outcomes to society and the environment at a systemic level. These material issues and real-world outcomes overlap to some extent, but not fully. And this is part of the gap that needs to be closed to achieve the SDGs by 2030. Now, which tools are specifically used for which purposes? We start with tools to set impact objectives. And here, sustainable development goals are used with 52% of respondents. Impact Management Project, IMP, based on the 5 dimensions of Impact Convention, which we mentioned, with 21%, and the IRIS catalog of metrics with 19%. If we look at tools to measure their impact performance, here we have Sustainable Development Goals Another Time with 37% of respondents. Then IRIS catalog of metrics with 36%. And IRIS Plus core metrics sets with 29%. And finally, we look at the tools to report the impact performance. And here, Another Time, Sustainable Development Goals with 48% are the front runners, followed by IWIS catalog of metrics with 27%. So we return to our table of contents and we continue with the next section titled Overcoming the Challenges. On one hand, impact investing belongs to the most valuable sustainable investment strategies, as impact contributes extraordinarily to the speed of transformation to a sustainable economy. On the other hand, market volume is disappointingly low. Yeah, is impact investing in a niche position, or what's going on here? Let's think about it. To be in a niche, a product must be low compared with alternative products. But as the other strategies do not deliver impact, niche is a false labeling here. So probably it's not right to talk about a niche position. The next slide explains the difference in assets under management between impact investing and other sustainable investment strategies. The other investment strategies can use financial products shown on the following slide, which is coming as the next, framed with red color. Now, impact investing is especially offered by young companies, new processes, or new technology, or new products. It's necessary that these projects can be financed by all types of investors and by attractive financial instruments. Let us step here to the most important financial instruments to discuss, if they can be used for impact investing. First, there are exchange-traded assets. And we can differentiate that into public equity and public traded debt. Then we have equity-like debt, debt between debt and equity, like mezzanine capital, deeply subordinated debt, debt with potential profit participation, like convertibles, warrants, and so on. And then there are non-exchange traded assets, like deposits and cash, private debt, private equity, real assets, investment of physical or tangible assets, as opposed to financial capital, such as real estate or commodities. So finally, investors have opportunities to invest into different stages of growth. They can invest in seed or startup financings. They can invest in venture capital or as with venture capital. They can invest in growing companies or in mature companies. Now the green frame highlights combinations attractive for impact investments, and the red frame indicates combinations unalluring for impact. Yeah. Now, what does it mean? Another idea to the last slide. What does it mean? It means that impact can be predominantly realized with investment instruments which are not publicly traded. And that means it's rather difficult to activate a lot of capital. Yeah. Good. Now we go on with the next slide. This slide shows a very interesting story on the use of debt to equity or private to public financial instruments for impact investing. As we can see here, and probably you need some more time to check this figure, The relationship of debt to equity investing is extremely high here. More privately than publicly traded investment instruments can be seen, and the average deal size is extraordinarily high for public equity and real assets. So that shows that it is really difficult to attract investments for impact investing. Irrespective of the above-mentioned point, the financial market's objective should be to increase impact assets under management. The other strategies show extremely high assets under management, so the other of the 7 sustainable investment strategies, as they invest in existing, mature and exchange-traded companies, and this offers nearly indefinite investment opportunities, and therefore all other investment strategies can offer big investments to investors, but impact investing cannot do that. Impact is primarily generated through young companies, sustainable processes, new technologies or products. New financial institutions now are needed to help impact investing, to develop financial instruments for sustainable activities such that all types of investors will find it attractive to invest into impact investing opportunities. This table lists greatest challenges facing the industry over the next 5 years by respondent subgroups, giving us very interesting insights. What we see here is impact washing is seen as the most important challenge for impact investors, followed by inability to demonstrate and compare with peers impact results. Have a look at this table. It's quite interesting and gives you very interesting insights. The figure anticipated direct contributions to roadmap actions over the next 5 years is quite interesting. The contributions are grouped into identity, behavior and expectations, products, tools and services, education and training, and finally policy and regulation. We return to the table of contents and continue with the next section titled Literature Review. This slide here gives an overview on the papers to be discussed in the literature review. This discussion here includes 3 papers. The first paper is by Barber, Morse and Yasuda from 2021 on impact investing in the Journal of Financial Economics. The second paper is from Findlay and Moran in 2019 on purpose washing of impact investing funds in the Social Responsibility Journal. And the third paper is from Phillips and Johnson 2021 on inching to impact in the Journal of Business Ethics. So let us come to the first paper, Barber, Morse and Yasuda in 2021. And for the literature review, we always structure the discussion into three parts. First, research question, then methodology, and then findings. So let us start with the research question here. The authors try to derive if investors are willing to accept lower financial returns for non-pecuniary benefits for international dual objective venture capital impact funds. To the methodology. The authors use a final sample of 159 impact funds. The first analyze the realized performance of funds by regressing the fund's internal rate of return on a key impact dummy variable that equals 1 for impact funds, and bring in a control variable. There are 6 variations. Secondly, they apply a discrete choice hedonic model for estimating investors' willingness to pay for impact funds. And here are the findings. Impact funds earn 4.7 percentage points lower internal rates of return ex post than traditional venture capital funds. The willingness to pay analysis showed that investors accept 2.5 to 3.7 percentage points lower internal rates of return ex ante for impact funds. Financing by impact funds implies, as a consequence, lower cost of capital for the portfolio companies. The positive willingness to pay result is robust to fund access, rationing, and investor heterogeneity in fund expected returns. Development organizations, foundations, financial institutions, public pensions, UN PRI signatories have a high willingness to pay. Investors subject to legal restrictions that discourage the sacrifice of financial returns for impact may reduce the willingness to pay for impact in reality. So we come to the second paper, Findlay and Moran in 2019. We start with the research question. The authors postulate that impact investing is institutionalized in a phase and in a phase, I start another time. So we start with the research question. The authors postulate that impact investing is institutionalized and in a phase of legitimacy building. They try to analyze how impact investing is deployed in global financial markets by examining its key elements. These are intentionality, returns, and measurement. I repeat that another time because legitimacy was not really very good. So we start with the research question. The authors postulate that impact investing is institutionalized and in a phase of legitimacy building. They try to analyze how impact investing is deployed in global financial markets by examining its key elements, and these are intentionality, returns, and measurement. To the methodology. Funds and products from a public database are systematically analyzed against the refined definition received by a structured analysis of academic and practitioner literature. to determine the rigor with which intentionality and measurement are applied by market participants. These elements are used as a proxy to determine purpose washing, a process where funds are presented as impact investments but do not satisfy a tightly applied definition. Purpose washing enables the possibility of retrofitting, where funds originally defined as other products, for example SRI, retrospectively claim to be impact investments. And to the findings. The authors found evidence for purpose washing, but not for retrofitting. Actions are identified to enhance impact investments' integrity, focusing on intentionality, measurement, and transparency. Clarity of definition and purpose are important for a field in the market building phase, as a lack of clarity could have negative implications for integrity and growth. The authors postulate that purpose washing may be attributed to two distinctive motivations by market participants. Interest in fee generation among fund managers and attempts to strengthen field legitimacy by demonstrating sector growth among impact investment proponents. And now we approach the review of Phillips and Johnson from 2021. To the research question. The authors try to analyze the perceived barriers faced by non-profits and social enterprises in engaging with social impact investing, arguing the need to assess differences using a policy field framework. To the methodology. This research is based on 25 interviews with leaders of non-profits and intermediaries in affordable housing and community economic development in Canada. 4 parameters of a subsector are conceptualized as shaping participation in sustainable impact, social impact investing. The scale of investment required, embeddedness in place, the need for radical innovation, and the configuration of intermediaries, such as loan funds and market brokers. To the findings. The study finds that significant barriers exist caused by a lack of knowledge of the market, inadequate financial literacy, and the challenges of measuring and valuing social impacts. In addition, non-profits, that means non-profit companies or businesses, report that in spite of inherent importance of social impact in this form of investing, they currently make limited use of evaluation and impact metrics and perceive that intermediaries and investors, particularly in affordable housing, still put a greater emphasis on financial over social returns. We refer to the reference list now, our last point. Please have a look at the referenced sources. Besides the 3 papers presented in the literature review, I want to point to the paper of Bush et al. In 2021, which is really very informative on the market, and the annual Impact Investor Survey from 2021 by GIIN, which gives a lot of detailed market insight. And on the second page, to the Global Sustainable Investment Review from 2020 by GSIA in 2021, which gives also a lot of helpful insight into the market. Well, ladies and gentlemen, we come to the end of this chapter. We hope that you now have a good understanding of impact investing. Impact investing is for sure at least among the most important sustainable investment strategies, if not the most important one. Although the assets under management are extremely low, but impact investing is so important as it is the strategy able to increase the speed of transformation to a sustainable economy. We could say that for the future, impact investing could become the fuel for accelerating the speed of transformation. If we will be able to reach that, then we will be in a very good position to fight against the negative climate change. Thank you very much. Thank you for your patience, and hope to see you soon in one of the next chapters.